Welcome to the monthly roundup from Kepler Trust Intelligence in association with Schroders. In this edition, Ryan, David and I will be covering all the news in the investment trust world over the month of April. So Ryan, could you start us off by running through some of the most notable news stories from the investment trust space over the past month?
Thanks, Joe. Yeah, of course, we start off this month with the news of some progress from the Saba situation. European smaller companies, one of the trusts that was a focus of both of Weinstein's activist approaches, has announced a large tender offer designed to end the issues with Saba. The details of this are a sort of 42.5% tender offer, including allowing investors to opt to take the underlying shares as well as a cash exit. The sort of large scale and size of this means Saba can completely be placated and remove themselves from the register, while also allowing the trust to continue in its present form, albeit potentially at a reduced size.
Who are the winners from this?
Well, I think it's a bit of a win-win, actually. Saba get to exit their position, having achieved their goals. The loyal existing shareholders get to keep investing in the strategy that they selected and chose, and the managers and board all get to keep their positions and their mandates. So only one can really hope that the managers use this as a bit of a reset to deliver some excellent performers and hopefully return the faith that investor base has shown.
And I understand there's been another announcement of a tender offer.
Yeah, that's right, Joe. We also had an update from the Pacific Horizon Trust, which has proposed a new conditional tender offer every 5 years. This Baillie Gifford Trust has had a very good long-term track record, having outperformed comfortably over the sort of long term, though it has had some sort of rougher patches since. However, beginning in 2030, should these cumulative 5-year performance numbers underperform the benchmark, investors will be entitled to claim up to 25% of their investment back as cash. Now, whilst this is a sort of step in the right direction in terms of corporate governance, it isn't potentially the most generous of schemes, although it should be noted that the managers, as with many of the Baillie Gifford approaches, are very long-term. Therefore, these timescales shouldn't be too unexpected, and the trust has had some strong periods of outperformance. Furthermore, the board are continuing a not insignificant share buyback program, which should also help with the discount narrowing.
And there's also been some news around Fidelity Japan. So what's been going on there?
Thanks, Joe. Yeah, the month saw the announcement of a so-called beauty parade for the assets of Fidelity Japan following an unsolicited approach from the peer AVI Japan Opportunities Trust to take over Fidelity Japan.
So a similar situation to Ashoka and Asia Dragon?
Quite right, very similar to that situation later in 2024 and resolving itself earlier this year, with the winning bidder ultimately being Invesco Asia, now Invesco Asia Dragon. The assets have merged. We've seen a similar situation here. The board are looking for a potential new home for the trust ahead of a continuation vote in May this year anyway, and this follows the announcement of the AJOT approach. Fidelity Japan's largest shareholder had publicly backed the AJOT approach, so I think it's safe to say that Fidelity's tenure was likely to come to an end. We're now just awaiting the results of this beauty parade, with the opportunity to either merge with one of a number of peers that exist, or even for a new management group to come in and try and reinvigorate the strategy. A real case of watch this space.
No doubt we'll bring you the results of that news over the coming months. Now let's move on to results. So Ryan, what's been catching your eye this month?
Thanks, Joe. Yeah, we're actually going to stick with Japan for the time being, and our first set of results, in particular, Schroder Japan Growth, or SJG. They published their interim results for the half year to the end of January 2025, which saw good outperformance with a NAV total return of 4% ahead of a 1.4% return for the benchmark, the Topix index. This was primarily driven by stock selection, with the underlying portfolio delivering good earnings growth, supported by the tailwinds of the corporate governance reforms, rising wages, and further business investment. All of these being positive long-term factors for the trust and the asset class. However, the smaller companies' tilt in the portfolio was a slight headwind. All in all, though, quite good numbers from the trust, considering the volatile backdrop, which the manager in fact capitalised on to add some high-quality names at attractive valuations. Despite this positive underlying performance, the share price failed to keep up with NAV, and this has led to a discount widening in the period, and this has been sustained since. Also, we think it's worth reminding investors that the trust adopted an enhanced dividend policy in mid-2024, meaning these results saw the first of the higher dividend amounts coming through, meaning the trust could well appeal to income-orientated investors too. Now, David, I understand you've been looking over the results from ORIT.
Yes, so Octopus Renewable Infrastructure Trust published its annual results for the 2024 financial year, which also coincides with the calendar year. Now, ORIT delivered a NAV total return of 2.5% and saw solid operational growth. Power generation rose by 7%, revenues by 12%, and EBITDA by 16%. Now, despite this, NAV per share did dip slightly to 102.6p, down 3%, mainly due to minor issues like shortfalls in some asset performance and adjustments in the development pipeline, which we'll come on to talk about later on. Encouragingly, though, the dividend target of 6.02p was fully met and covered 1.24 times by cash flows, marking the third year of CPI-linked growth. Now, for 2025, the goal is to increase this further to 6.17p, indicating a forward yield of around 9% currently. To support this, fixed revenues rose to 84%, while nearly half of long-term revenues are inflation-linked. Debt is being actively managed, with average borrowing costs cut from 6.5% to 5.25% following a refinancing, which should help manage potential power price volatility and add visibility to the earnings potential. ORIT also demonstrated its capital potential in the period, evidenced by the €74 million sale of Swedish wind farm, generating an 11.3% internal rate of return. Alongside this, ORIT has been actively recycling capital, buying back shares, reducing debt, and investing in developers like Simply Blue, where it holds a 20% stake, another one we'll come on to chat about very shortly. Now, we believe this demonstrates that ORIT isn't just a bond proxy. It's showing good upside potential in capital terms, as well as attractive income characteristics. Arguably, this is further enhanced by the wide discount of 34%, and has been undertaking significant share buybacks in the period to support this, plus making these part of a future capital allocation policy to help further.
Thank you for that, David. Some really interesting numbers in those results there. Moving on, but actually sticking with the trust, you sat down with the fund manager, David Bird. What did he have to say?
Yeah, so we did kind of touch on the scale that ORIT has behind it in terms of the managers sitting within the broader Octopus Energy Group, which listeners will probably know mainly as a supplier of gas and electric to households. But ORIT, benefits from the fact that its managers can chat to people who kind of talk to end customers, people who are, very well connected with policymakers in the UK, in the government, which helps with kind of insights into what's coming down the track. But we also had an interesting spin through ORIT's portfolio, which is perhaps one of the most diversified across not only renewable technologies, but also geographies, which is beneficial for shareholders because it provides exposure to very different weather systems. Now, ORIT does have other interesting abilities. So it can invest in assets or companies at the development stage, which is kind of essentially everything before a project actually gets into the construction stage. And it potentially provides higher returns on a very small portion of the portfolio. So I think the max they can invest there is about 5%. Now, one of the companies that he spoke about, which we've mentioned already, is Simply Blue Group, which is developing floating offshore wind farms as well as sustainable aviation fuels. Joe, you spoke to Charlotte Morris, co-manager of Pantheon International, for our Market Matters podcast. What did Charlotte have to say?
Yes, by way of quick recap, Pantheon provides exposure to private equity markets, not only in the US and Europe, which you probably expect, but also Asia and emerging markets, so very much a global reach. Unsurprisingly, we started off discussing tariffs, and Charlotte's view is that we won't see the impact start to hit really until the end of this year, maybe into early next year. That market volatility has put pressure on exits. There's been a pause in a couple of high-profile IPOs, and the sell-off has also had an impact on company valuations, both in private and public markets. We also talked about why private equity managers can deliver such consistently strong returns over the long term, and Charlotte really attributed this to three things. Firstly, growing earnings, secondly, using debt selectively, and finally, helping to build a stronger business that commands a higher valuation. But we did also speak about the wide discounts in private equity trusts and the need for transparency around valuations. I think Charlotte felt that exits at premium should improve investor confidence on this, as well as further clarity over the hot potato of cost disclosure rules, which I'm sure we'll be covering again in next week's podcast. And finally, we spoke about private equity funds getting rather a bad rep. The press tends to focus on the failures of the household names rather than the less well-known success stories. So perhaps also a need to improve the PR on that front. Now, David, you took a look at judging skill versus luck in fund management. So what did you find out?
Yeah, so now one of the kind of big questions within the evergreen active versus passive debate is whether kind of long periods of outperformance are due to a fund manager's skill or whether it's just luck. Now, clearly, it's hard for anyone really, whether that's an ordinary investor or a professional investor, to kind of judge what skill active managers have. But there are some ways we believe that you can kind of tilt the odds in your favor. And certainly investing in some of the more niche areas where information might be a bit more difficult to come across, such as emerging markets and smaller companies, require more intimate expert knowledge. Now, we think that Ashoka India Equity is a great example of an active manager that has tilted the odds in its favour. That's because the vast majority of the alpha that it's generated over the benchmark index has come from stock picking. A decision hit rate of 61% is also well ahead of the 55%-ish that's kind of often seen as the industry standard. For these reasons, we think that AIE's very high quality alpha generation sets it up for sustainable and enduring outperformance into the future. And you can read a bit more detail on this in a new feature on the KTI website called Alpha Bravo Charlie.
David, you covered the most and least popular shares and trusts with investors in March. So who was flavour of the month there?
Yeah, so I think the interesting thing about this was it kind of covers the immediate period before Liberation Day. So it's certainly an interesting time to be looking at the data before Liberation Day, but I was looking at after Liberation Day. So, it was quite an interesting thing, one to write. But one interesting theme that kind of came through is that defence shares are high on the wish list, which probably isn't surprising to those who are kind of listening to the news. Now, Rolls-Royce and BAE Systems are kind of evergreen on this list here. But one new addition was Kinetic, which is a small UK company which kind of provides technology solutions to both defence and security firms. So yeah, a really interesting one to get on the list. Moving on to the investment trust front, there weren't that many changes, to be honest. Scottish Mortgage and JP Morgan Global Growth and Income always kind of lead the charge generally. But there were a couple of new re-entrants, which were Alliance Witan and City of London, the latter of which kind of could be seen as a good port in the storm for those looking to diversify away from Trump's tariffs and the US. Joe, you picked up the slightly poisoned chalice of writing about your own portfolio in the aftermath of Liberation Day. How's your portfolio been weathering the storm?
Yeah, I have to say it did feel a little bit like a poison chalice to be on the hook for this month. And I went with the headline, "A Nightmare on Wall Street," as it felt a little bit more like getting poor quickly than getting rich slowly. However, I did take the view that turbulence is probably a good, if not entirely welcome, test of the resilience of my portfolio, which frankly is probably a little bit on the aggressive side. I think a couple of learning points for me. Firstly, the obvious one of keeping your emotions in check and not being tempted to panic sell. It's really hard to ignore a sea of red on your trading app, but actually my loss in the first fortnight of April was around 5%, not the 15+% I'd feared. And there was quite a lot of recovery with the big pause. Secondly, on the resilience front, my small allocation to bond funds held up well. My 25% allocation to alternatives was a little bit more of a mixed bag. So the private equity and all related investments took a hit, unsurprisingly, but the infrastructure and clean energy funds emerged relatively unscathed. But I think I need to think more about correlation and perhaps dialing down the adventure element given the current market volatility.
Thank you for that, Joe. And that is it for this month's roundup of investment trust news. We'd like to say another thank you to Schroders for sponsoring this edition of the monthly roundup podcast. And if you'd like to find out more about any of the topics we've covered today, head over to the Kepler Trust Intelligence website, and we hope you will join us again soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.